beginning part. Well, welcome back. This is Joshua Thompson at Thompson Tax Group. Today we have a guest, Jaycee Greene. We're going to talk a little bit about real estate loans and kind of what he does as well, the different type of loans out there, how it can benefit you as a real estate investor. And usually on these calls, we try to keep it between about 20 and 30 minutes, just kind of give you some information as a business owner, as a real estate investor, or a lot of you guys as clients as well, just to give you that one more tool in your arsenal as you guys are growing your business. So, Jaycee, if you don't mind just introducing yourself for a little bit, tell us a little bit about what you're doing and kind of how you're working with clients.
Sure. Jaycee Greene. I am based in the St. Louis area. My professional background is working as a commercial and corporate banker, primarily focusing on lending to small, mid-sized businesses as well as real estate developers. And most recently, I have embarked on my own consulting, working with generally small to mid-sized developers. Some folks would refer to them as mom and pop developers that are just trying to acquire a nice real estate portfolio to be their nest egg, their own 401k, so to speak, that can generate cash flow and then ultimately appreciation for them in the future. And so I focus on helping them with the financial side of that, and particularly the financing side of that, of getting capital to finance their projects.
Well, I appreciate that. I mean, let's be honest, at the end of the day with real estate, you don't necessarily make your money when you sell, it's make your money when you buy. As you're getting everything set up, run your numbers, make sure it's going to be a deal and it works, make sure your financing's all taken care of. Any credits, depending on what you're doing, you're qualified for credits as well, whether it be the local level or the federal level, whatever it may be, you want to make sure you're well taken care of at the beginning because we don't want to have to figure it out down the line. As you're working with clients and individuals, I would ask, when do you think is the time you think someone should be reaching out to working with you?
Ideally, it is once someone has kind of started doing the real estate development on their own, has been successful in maybe one or two deals, so they've kind of figured out the things they need to do, things they don't want to do.
Right.
Everybody says it takes the first project always takes twice as longer and costs twice as much.
Yeah.
And so it's really hard to get a third party lender to finance kind of those overages. But if someone has the capacity to finance that on their own, just to get their feet wet and get to the point where they're like, okay, and also it's figuring out what kind of asset class and what type of property they want to focus on too, because a lot of the folks I work with, they have a personal connection to a market, the type of tenant or type of home buyer that they're targeting. So they oftentimes will focus their acquisition efforts geared towards those end users.
Yeah. No, I see a lot of times where it's the new real estate investors. They know they want to get involved in real estate. They just don't know the avenue where they want to go from here, or even how to approach it, or look into the financing. Or they may have a good W-2, but they want to change their W-2 into more real estate stuff, but they just don't really know where to go from there. So I'm glad that's an area that you can help out with, especially with developers and so on that are doing that. When you say developers, is it also fix and flippers? Is it also long term, or is it mainly in developers?
It could be any and all. It's the fix and flippers tend, they're the quick hit, generate some fee income. That's almost, they're kind of running their own. It's kind of their own W-2, so to speak. That's generating their monthly income.
Right.
And then oftentimes I'll work with folks that started to fix and flip to generate that kind of that nest egg, so to speak, to then be able to invest in a long-term rental property.
Right. Okay. Oh, sounds good. Well, I always like to kind of ask as well is, do you have a story you wouldn't mind sharing with everyone as far as how, like a client you work with, how you helped them and the impact you made when they came on board started working with you?
Yeah, I'd say I always love to tell the story about my client, TJ Jolly in Kansas City. He and I had a previous relationship as I was his lender
Mhm.
on some properties that he was trying to develop and redevelop Kansas City, kind of in their urban core. And what I was doing at that, we were back then we were focused. The lending group fund that I was with was focusing on heavy rehab types of
Mhm.
projects that weren't necessarily being financed by banks or credit unions. Hard money usually wasn't interested in those types of properties. So we, I met with him and got to know him and understood how amazing how well he knew that market that he was in.
Mhm.
This kind of this tells me not everybody it takes some for a lot of folks it takes a while to get to the point where here's
Yeah.
here's how much this is going to be worth. Here's what I need to do, or here's the most I can spend on a rehab. But he was targeting uh, single family rentals. Generally was buying them for less than $30,000,
Okay.
but he would have to put $100,000 into the rehab.
Right.
But then they were located generally near colleges or hospitals or some general area within Kansas City that that could support what they call ARVs, after repair value. Um, and what I always remember with TJ when I was doing the lending, we were financing three of his properties, and he gave me an initial estimate of what he thought each of the properties would be worth after he was done with the rehab. And when we got the appraisals back, he was within 1% each of the properties. And so that kind of tells you really quickly that this guy knows what he's doing.
Right.
And so I was happy to lend him as much money as he wanted because TJ is really focused on giving back to his community through
Right.
his real estate development skills.
Mm-hmm.
And so he has cobbled, and since then, this is going back about 5 years ago, when I did this loan, um, he um, has cobbled together. Hold on a second. He had cobbled together about 20 single family rentals
Mm-hmm.
up to about 2 years ago. It took him about 6 7 years to put those together, and he was doing those kind of basically on his own, um, getting the financing, doing the um, acquisition, kind of finding the
Wow.
properties. Yeah,
Yeah.
and
That's time.
he also has a tremendous knack for developing relationships with social service organizations in
Okay.
Kansas City. So they just feed him a pipeline of tenants because
Wow.
they have folks in the communities that are looking to house people
Mm-hmm.
in and around those areas. And he's become the uh, kind of landlord, preferred landlord in those areas. So people come to him,
Wow.
tenants, but also with people want to sell him properties because they know he's going to do right by the neighborhoods and redevelop the property like community want.
Yeah.
But so about 2 years ago, he hired me to be his part-time CFO because he had gotten to the point where he wanted to double the number of units that he owned
Mm-hmm.
in 2023. And he realized that in order to do that, he couldn't do that all by himself, knowing how much of trouble or how difficult it was for the first 25. He said, I've got to bring on a team of kind of trusted professionals that can help him scale his portfolio.
Yeah.
Me on a CFO, hired an attorney, kind of changed, got a real estate focused accounting group to work with him. And then also kind of leveraged up his property management business
Yeah.
as well. Um,
Okay.
so what we've done kind of since then is we're working with lenders to finance his property acquisitions, rehabs, and then refinancing into long-term
Yeah.
financing or DSCR loans, which I think we'll get to
Yeah.
later in
Next.
this. But what we were able to do back, actually just this 3 months ago, we were able to refinance 40 of his properties with a very conservative local bank
Hmm.
in the city that cashed him out about $1.2 million.
That's not bad at all.
And it's something that he has cobbled together this portfolio, and a lot of real estate developers against it, get under a cash crunch because they've got a lot of trapped equity.
Yeah.
And it's oftentimes what TJ will do, he'll tell you right now that most of that 1.2 million cash out is going to go into probably 5 new acquisitions.
Mhm.
So it's just it's ultimately helping real estate developers like himself kind of optimize their their cash flow and their
Right.
their capital and their leverage.
Okay. Yeah, let's unpack that a little bit. I want to start with
Yeah,
the DSCR loan. I mean, it's one thing that I know me and you've talked about in the past. One thing a lot of, I would say, seasoned investors typically know, but the newer investors may not be aware of it, are investors that want to get in the market but may not have income to meet, the requirements of a typical loan. Can you talk a little bit on the DSCR? What is it? How
sure.
investors can utilize it?
Sure. Yeah. The DSCR, the debt service coverage ratio loan, is kind of the simplest kind of description of it is the lender wants to make sure that you have uh, at least it's usually like 20% or 25% cushion
Hmm.
in profit compared to your uh, loan payments, your debt, what they call debt service.
Right.
So they just want to. It's kind of it's a coverage ratio that makes sure that you've got enough cash profits being generated from the property
Hmm.
to pay the loan, and a lot of investors looking at DSCR loans oftentimes they'll you know use the DTI or debt to income ratio interchangeably, and DTI is more of, in my experience, is more of retail or like that's what you're based on your home mortgage. That's how those are the ratios they use for the home mortgage or your car loan.
Right.
Whereas DSCR, most lenders don't that do DSCR loans are not necessarily looking at your personal income. They're looking at the cash flow from the property. So
Right.
they're taking the view of the property that you're acquiring and you're going to hold long term. That is a cash flow generating asset. So it's focused. The borrower has to generally has to provide a personal guarantee that if something goes wrong, you have to come in and make payments. But in
Right.
general, they want the property itself from a cash flow perspective to be able to pay the debt service.
Okay, so it sounds like with the DSCR loan, the best time to utilize it is usually in a market that's cash flow, and say the Midwest or some places in the South may be better instead of California, where sometimes you're in a negative every month trying to rent this thing out. Is that true?
It can be. You'll have those types of markets. You might have to lean towards more creative financing,
Right.
or kind of more. I don't know if it would be asset based per se, but um, oftentimes those DSCR loans, it's hard. It's hard to make the numbers work on those types of properties.
Yeah. Okay. So
But there's tons of different lenders that kind of focus on different types of properties and different So I
Right.
work with folks all over. I work with folks, developers and lenders all over the country.
Right.
Each when I first talk with an investor, wherever they are, I'd like for them to talk with lenders in their local community because those are generally going to be the lenders that know the most about the property, about the area.
Right.
But if it's something that's maybe, these are a little more customized or creative financing, then maybe you go to more kind of a specialized hard money or private money lender.
Okay. Gotcha. I want to kind of touch on what you were talking about with TJ was uh, he refinanced, or I guess he bundled all the, I think it was about 40 properties you're mentioning, and
Yep.
bundled it together. Was that in a refinance kind of like a portfolio loan, or was that something else?
Yeah, ultimately, your portfolio loan, meaning most real estate loans are property specific,
Hmm.
and oftentimes that's and much of it's generally, in my experience, is generally a result of the fact that the properties are being acquired one at a time,
Right.
and so each property has its own loan, its own payment. Because oftentimes the investor, they're like, okay, I need a loan for this property. Let's close it. Let's put it on the shelf. Set those payments up for the next 5 years until we have to refinance.
Hmm.
They kind of stop thinking about it.
Yeah.
It kind of goes on autopilot. But especially in situations and maybe markets that are seeing decent amount of appreciation, or um, you have you've done a significant amount of rehab that's kind of created
Yeah.
higher appreciation, then maybe over time you look at, hey, based on the current value, could this be a candidate where we could bundle some of these properties together to basically pull out some cash. So yeah, anything. I don't know if it wouldn't necessarily have a specific number, but having a multiple properties in under one loan
Right.
would be kind of considered a portfolio loan. I'm
Okay.
actually working with another client in Phoenix, Arizona right now, uh, doing another deal like that.
Okay. Yeah.
Yeah.
Well, if it's anything like TJ's, I'm sure it'd be fruitful and help them grow that portfolio for sure.
Well, and that's an example of sh- the cash flow for these properties, because the for her the value of the properties
Hmm.
less about the actual structures. It's more, the land is actually worth more
Oh.
than the structures because of the development that's going on
Mm-hmm.
in those areas.
Mm-hmm.
So so these properties would cash flow under a traditional DSCR loan,
Right.
particularly like with a bank DSCR, it would never cash flow. But there are other options where the DSCR, non in most simply, it's a non DSCR loan. It's more of a either asset based loan, or it's not based on the cash flow of the property.
Yeah. So I think you mentioned earlier a little bit about the portfolio loan. Is it fair to say, in summary, a portfolio loan is when an investor has multiple properties, multiple different loans, and want to basically have one loan for these group of properties?
Yeah,
Okay.
and
It.
that can be sometimes you would find that where they're trying to gather the same type of asset, like they want
Mhm.
to refinance all their single family rentals,
Yeah.
or maybe they have a bunch of 1 to 4 multifamily.
Hmm.
You could bundle those together. You could also have it based on the market, like if they have um, properties in different markets,
Right.
they may look at it that way as well. Um, banks tend to be very specific. Credit unions tend to be very specific to those markets,
Yeah.
whereas the hard money lenders generally have a little more flexibility in financing properties in multiple in the same loan.
Okay. I guess I would ask, because my mind's going as for the real estate investor side of things. If you're looking at a portfolio loan, say you have multiple loans, you recently got them. Let's say you're all at about 7%, if you decide to, I guess, refinance those multiple loans into a portfolio loan, would the percentage be right around 7 as well? The current market, or is it a little bit higher? Is it a little bit lower because it's such a larger dollar amount in the loan?
Um, it'll be all based on cash flow
Okay.
properties. I mean, they would, you could have it where some of the properties that when you originally put them on
Mm-hmm.
CR loans, maybe their debt service coverage, maybe one or two of them was lower, and a couple other ones ended up being a little bit higher than the others.
Yeah.
But by kind of pooling them together in a portfolio loan, you might be able to generate a little extra cash flow. You kind of group them together
Yeah.
and pull out some because it's generally based. When they're first putting them on, it's just based on that specific property.
Right.
You'll hear a lot of, especially bank and credit union lenders, will talk about the property specific debt service coverage, and also what they call global debt service coverage. Global just means what is your entire portfolio? What's the cash flow of your entire portfolio versus one specific property or
Right.
two of your properties maybe that you're looking to do a portfolio loan on.
Gotcha. Okay.
Yep.
I can go on and on about portfolio loan and ask more questions on it, but I want to kind of transition to something that we talked about. I think it was last week or about 2 weeks ago. It was the CRA, the Community Reinvestment Act. I believe you mentioned it.
Yep.
Would you mind touching a little bit on what that is and how investors can take advantage of that?
Yep. Yeah, the CRA or Community Reinvestment Act was enacted in 1977, following many years of what they call redlining, which was where banks and credit unions were uh, uh, literally drew a red line on maps to designate areas that they should not in. Generally, those were communities of color, low to moderate income.
Mm-hmm.
So those communities basically were excluded from in those general terms, it was home mortgage lending.
Oh,
So it became
okay.
it was almost impossible to get a home mortgage in an area that was considered redlined versus kind of the suburbs or the higher income areas,
Mhm.
various communities. So the CRA, the Community Reinvestment Act, was created to require banks and credit unions to, or I'm sorry, I think it's just banks. Credit unions have their own deal, but for banks to invest in their communities around their branches. Investing means lending, investing, and community service.
Mm-hmm.
Ultimately, instead of if a bank has a branch in a specific area of a city, but they're lend they only they all and they're not in a very that's in a low to moderate income area, but they don't lend in those areas. They only out to the wealthier suburbs, and that would come up on the exam saying that they're not investing in communities near their branches. And the banks are they're uh, looked at. These are looked at on a rolling 3-year basis. So every 3 years they'll have an exam that the regulators will come in and give them kind of uh, it's a pass, needs improvement
Mm-hmm.
type of deal. And then after 3 years they get that exam, then that's kind of the clock starts over again.
Mm-hmm.
So it's a kind of an ongoing requirement that the bank, it's not the bank just can't say, oh yeah, we did a lot of stuff last year, so good for
Right.
10 years. Like no, every 3 years, the clock, resets.
Yeah.
So a lot of folks that I work with, and this can be in really any community, and specifically with TJ, he's focused in an area of Kansas City that is viewed as a CRA low to moderate income area.
Mhm.
And there are banks that will provide better terms and conditions
Right.
if those properties are located in those CRA eligible areas. And it's not something that's generally marketed very well by banks.
Yeah.
Um, you can generally figure out who to work with the bank, like for these types of projects, if they have a community development, if they have a community development group. That's
Mhm.
the community development group is focused on their CRA
Oh, I
efforts,
see. Yeah.
and so those that community development is focused on the bank is sometimes the banks will give donations to certain organizations in low to moderate income areas. They'll Junior Achievement is an organization that tries to improve literacy and
Mhm.
education in schools by bringing professionals into schools to teach programs.
Right.
That would be kind of a community service aspect. And then the lending would be that the banks would lend on provide loans for projects in those low to moderate income communities. And oftentimes those um, those loans need to be underwritten kind of using a different rubric than their traditional
Right.
credit policy. And so that's where I kind of the value that oftentimes I share with my clients. And TJ he's nicknamed me the bank whisperer. That I can figure out or I can find out if a bank or banker um, can do a certain deal or a certain project pretty quickly.
Mhm.
Um, and a lot of times it's just either I'm saving him time, having to not spend time with the person that I know he's not never going to be able to do a good enough deal for him,
Yeah.
or say, okay, let's get a quote from this bank, but there's a couple other banks in the community that do these types of loans. Let's see what they're doing now. I'm doing the same thing. I'm doing that for a client in St. Louis, my market, St. Louis.
Yeah. Okay. Yeah. No, so it sounds like the CRA makes it, I guess, is that one of the main reasons a lot of people say go to your community banks before going to the big brand banks if you're looking at, needing funds in your area?
Uh, yeah, I would say even without even if you take out the CRA
Mhm.
aspect of it, I would generally focus on that because the the big banks generally are, and I used to work at some of those, they're not generally that good at dealing with the mom and pop investors. It's a it's a small deal for them. They're not
Right.
they're generally looking for the big 100 unit new construction apartment building
Yeah.
that's being done by a very well-heeled developer.
Hmm.
So, but the banks that have branches kind of embedded in a certain community, of folks that bankers that live and work in those areas know what's going on. They tend to they tend to be more real estate friendly, is what I
Hmm.
call it, because not all banks like doing what this would be called as investor real estate or non-owner occupied real estate. The
Right.
home mortgages, that's more, that's a loan for people that are living in the property,
Right.
whereas this, non-owner occupied is viewed as a little bit higher risk, but there are generally banks that are in those local communities that do these types
Okay.
of loans.
Do you typically see the CRA coming into play more so for developers that want to develop in that community, or do you think a real estate agent or real estate investor that has multiple properties, multiple loans that want to, I guess, transition into more of a portfolio loan at a community bank, could they do that under the CRA and get a better terms, or is it not really for the long term buy and hold, more so the development side of things?
I would say it would be more specific to the areas or the communities where those
Okay.
properties are located. You know, you could have, in like with TJ and a couple other um, clients I have, they have made a concerted effort to go into a low to moderate income area, redevelop real estate. Whereas, so that's kind of their primary reason
Hmm.
for real estate. Um, Whereas, kind of the typical investor, they may end up buying a property that happens to be in a kind of a CRA
Right.
area, but maybe it's not necessarily something that they're primarily going after. Because realistically, you know, it, you would almost, it's not exactly apples to apples, but quote unquote CRA is somewhat similar to Section 8
Mm.
rentals. A lot, if it's a generally if it's rentals are Section 8, it's probably a CRA eligible
Okay.
area. Uh,
Interesting.
the 40 units that TJ just refinanced, 20 of them were Section 8. But it doesn't have to be it doesn't have to be Section 8 per se.
Hmm.
And it doesn't have to be specifically um, CRA specific. I think, in my opinion, to get a bank that um, sees a developer, kind of like this TJ, this bank in Kansas City got to know him on a personal level. They saw what he was doing. TJ is very visible in the real estate development community
Hmm.
in the city. So it kind of got to the point where the folks at this bank said, we love what you're doing, TJ. How can we help
Yeah.
you? And whether they're CRA or eligible or not, for them, they knew much of what he was doing would be in CRA areas, but for all intents and purposes, they were wanting to do business with him wherever the property.
Yeah. Okay. Well, listen, I appreciate the information and the knowledge. I think we could dive deeper into it, and we'll probably have to have a follow-up call where we're talking a little bit more detail
Yeah,
about everything else, whether it be portfolio loans, DSCR, follow-up questions clients have that they'll send me after reviewing this, and we'll probably schedule that other call later this
yeah,
year or in 2025. We're recording this in
yeah.
2024. But other than that, I would say to kind of summarize everything, or I guess wrap everything up, who are you looking for right now as a client, and where's the best place people can reach out to you?
Yeah, the the folks that I love working with most, they're the folks that they know what the properties they want to buy. They know the market. They know how much things are going to cost them. They're very solid on the asset management side of things or asset acquisition side of things. But oftentimes it's where they just either don't have the time or don't have the interest dealing with the bankers or the lenders.
Hmm.
And that's generally where I can come in and add the most value for what I do is that I just really kind of help them take a load off of their
Yeah.
shoulder and hopefully bring them good options for them to choose from for financing. Um, and, best way to reach me is through email. Um, I'll share that email with you or post that.
Yeah, I'll include it. Anyone that reaches out, I'll
Yeah,
also send it over to them
yeah.
as well. So more than happy to do that. But no, I 100% agree. I think at the end of the day, if you want to grow your operation, if you want to grow what you're doing right now, having that team is extremely important. Whether it be
Mhm.
a CFO in there helping you get financing, an accountant in there helping with tax and bookkeeping, financial
Yep,
advisor, an attorney, you need that team because without that
yep,
team, there's a lot of areas you could stumble with, and sometimes you
yep.
just need that. Even if you're well versed, there's that one thing that team member can add that can alleviate a headache down the road. And there's so many calls. I've had multiple calls this month with individuals who want to come on board. They're like, but I already think I know everything. It's like, there is, but have you heard about X, Y, Z, right? And for
Right.
them, in that case, it's not. It's like, well, if you didn't do this right, if you didn't do that right, we may not have a problem right now, but 2, 3 years from now, you can have that either large tax issue or everything just blows up. And unfortunately, we've seen that plenty of times. So having a team is extremely important. I 100% agree with you on that one.
Yep.
But other than that, Jaycee, is there any last minute words? Anything else you want to add before we conclude for the day?
Yeah, what I find with a lot of real estate developers, especially the kind of emerging, aspiring real estate developers, they oftentimes will reach out to the wrong banks,
Yeah.
initially. Oftentimes it's because either that's the bank that they have their checking account with, their home mortgage, or that's the closest branch. Based on depending on the market, that tends to be a bigger bank.
Yeah.
So they oftentimes will get discouraged because they're not able to find what they're looking for, and that then is just a opportunity for me to check in their local market, find the banks that are more real estate friendly, and make some introductions pretty easily.
Yeah. Well, listen, I appreciate the time. I want you to stay on after I have a client I want to talk to you about
Yep.
real quick. But
Yep.
other than that, thank you again for the time. Definitely see you back here soon. If anyone needs Jaycee's information, feel free to reach out to me. Joshua Thompson, Thompson Tax Group. Send me a text, an email, 805-364-0908. If you're already a client, you already have all the contact information. But thank you again, Jaycee. I'm looking forward to speaking with you again.
Thank you, Josh.